Hi, I'm Rob Langton from Development Ready. Our interview series delves into the lives of Australia's most respected property thought leaders and decision makers and uncovers what makes them tick. This is the interview. Marco Gattino, Managing Director of Goldfields Group. Marco, thanks for your time this morning. I want to take it right back. How did you get your start in property?
Yeah, I had an indirect route into property. I think a lot of people do. I was a lawyer in a past life, spent a couple of years practicing. I was with a firm called Mills Oakley, who've got a presence in property. And in the late 90s, I came across Clement Lee, who's a prominent figure. You'd probably be aware of Clement and what he's doing in the industry. He's a veteran these days, very well regarded, certainly highly regarded by most of our peers. He was a client of the firm, and my passion for the law wasn't there. And I certainly was taking an interest in property and felt that there was a draw towards property. And so I cold called one of his partners, Luke Adams, who's also very prominent in the industry. And fortunately, I was able to get a job with them in 2000. And I went in and wasn't real sure what I was going to do. I knew I was going to do some legal work, but I ended up becoming a bit of a utility man, jack of all. One thing led to another, and in 2001, we set up a company called Asset One, which had a strong presence in land, masterplanned communities, and then we also went quite deep into commercial. So one of our most well-known assets was the World Trade Centre precinct. So we developed that. So I spent almost 10 years with Luke and Clement, learned a lot, gained a lot of experience, a lot of insights, and got to the point in 2010 where I felt that it was probably time to go and do my own thing. And that's where Goldfields was born.
Absolutely. And what was your role at Asset One?
Well, by that stage we were developing, so we effectively set up a development entity with the support of Clement and Luke. We went off, acquired sites, developed them. I was doing almost everything, whether it be site identification, feasibilities, finance, applications, getting involved in development management. It was a small company, it became a big company. And I was fortunately there day one, so as the company grew, my skill base also grew with it.
And then in 2010, I think you mentioned there, you started Goldfields Group. What opportunity did you see at that time?
It was an interesting time in the market. We'd come out of the GFC. Stimulus had certainly done its job in Australia. I think you'll recall, I think it was called the Libraries and Canteens strategy or initiative. And it certainly had a positive impact on the market. And I saw the opportunity at that point in time to align with the secondary non-bank sector that emerged out of the GFC. You had a lot of ex-bankers who went off and set up their own shops and were looking for experienced, motivated developers who they could support. So, the Qualitases, the Monarchs that came a bit later, IDA, which I'm sure we'll touch on today. We're doing more stuff with those guys today, but those independent shops that was really starting to gain traction and market presence. I saw the opportunity to align and build a business around those relationships.
And how have you found the business has grown over the past 10 years? And along with that, how has Melbourne changed over the past 10 years?
From the early 2000s had begun what I saw as a very strong, consistent trajectory of growth, mainly driven by population growth. The numbers of population growth we were seeing in the noughties and then post-2010 were unprecedented. They were as high as they had ever been in Australia in terms of percentages. And at the same time, we were seeing this tremendous value growth as well, the inflationary effect as a result of the population growth. If you look at the OECD stats, our ability to have consecutive quarters of growth is a world record. And where we sat in terms of OECD nations in terms of continuous growth was number one, and property was a clear beneficiary of that. And I was able to witness almost 20 years of that, 30 years of consecutive growth.
And the business today, who's involved and what's the focus of the company?
As the founder of Goldfields, I'm heavily involved, mainly in macro strategic decision making, but I'm also heavily assisted by my COO, Lachlan Thompson. And together, we're evolving and growing the business nationally.
And what are some of the projects you've got underway at the moment?
Our most prominent project in the market at the moment would be 627 Chapel Street, which is a 24,000 square metre office tower. That's currently under construction and will be handed over to us in October 2021. So it's not far away. It's about 16 months away. We've got various masterplanned communities around Australia. We've got a large one in Rockbank called Bridgefield. It's a 1,000-lot community. We've got a 1,300-lot community in Ballarat called Winterfield, a 1,000-lot community in Ripley, Brisbane called Hayfield. We're in the planning phase on a couple of large sites in Chatswood, North Shore, Sydney. We've launched a boutique development in Pymble, which is a prestigious North Shore Sydney suburb, which has been very well received by the market. That's a snapshot of some of our deals, but the business is broader than that.
And what are some of the intricacies? So you develop in Adelaide, Melbourne, Sydney, Brisbane. How different are each of those markets?
Yeah, very different. Obviously, a market like Adelaide doesn't have the depth of the eastern seaboard markets, so we position ourselves in terms of sector and size or scale of development to suit that market. Different markets are also complemented by vertically integrated businesses that the group owns. So SA is heavily supported by our building company, so that has a very specific mandate and initiative in terms of what we do in SA. Vic is a much bigger market, deeper market, allows us to play in a few different sectors. So we're in commercial, land, built form, residential, and we're embarking on our first hotel development in Richmond as well. Sydney's similar to Melbourne in terms of its breadth of opportunities, but you're dealing at a different price point. Therefore, the deals are bigger by way of dollars and volumes. It's a very competitive marketplace. I would say it's a more competitive marketplace than Melbourne. Good sites are always hard to come by, but in Sydney, they're especially hard to come by. Fortunately, we've got good guys on the ground up there who are getting access to good deals, and we're building a very good footprint inner Sydney at the moment.
You mentioned one of your projects there, 627 Chapel Street in South Yarra, luxury office tower. Tell us about how that opportunity came about, and then also, I think you used non-bank lenders to source the finance component of that.
627 was formerly owned by Fridcorp. I think they had other ideas about where they were positioning their business and where they were wanting to take Fridcorp. So the opportunity was presented to us by Melbourne Acquisitions, Dominic Gibson. We had a look at it, and we could see an emerging trend we could already start to see early signs of decentralisation out of the CBD, and also just the value proposition whereby we could deliver an A-grade tower with all the amenity of being in the CBD at a rent cheaper than the CBD. Plus, there was no true A-grade, or when I say A-grade, property council defined A-grade building outside of the CBD within that South Yarra precinct. And we saw it genuinely as a once-in-a-lifetime opportunity to utilise that site as an A-grade office tower. So if you take a walk down Chapel Street, so north of Toorak Road, there are no real opportunities to be able to deliver what we're going to deliver at 627. And Como has typically performed very strong for the very reason there's been very little competition in that market. So we felt it was time to bring a high quality A-grade office building to that market. And we've always felt that there'd be a lot of demand and interest in people moving into the building, and we've seen that since we launched our campaign.
And raises a good point. Why do you think developers, you look at Claremont Street, Yarra Street, anywhere in that Forest Hill precinct, it's all residential. Why do you think they've neglected office? Have they just overlooked it?
No, they haven't. So the true vision for Forest Hill is to be a truly mixed use precinct, integrated office and residential. Just the metrics, steered the opportunities to residential. Okay, so what the problem was, when you factor in land price, build cost, the rents hadn't caught up yet to justify a scale office building. And in my view, that only happened, the crossover happened where rents could support it in about 2018. To me, that was the start of a run where rents then went from circa mid-fours, face, to now we're talking 600 plus face.
And you did the project, I think, on a speculative basis as opposed to the pre-commitment. Yep. What are some of the risks or benefits in doing that? Firstly,
we had a very understanding lender and builder who were part of the lending team that allowed us and had the faith in us to get on and spec the building. Not only does that allow us to get on and deliver the building in a very timely way, but also I think underpins and endorses our view around the potential demand and also the quality of the asset. The benefits are also that people looking for new space can plan their future with certainty. So if you walk to the site now, you can see that genuinely the site will be delivered by October 2021. So you can start to plan your tenancy requirements around that date. I think it's very hard not to spec and get a commercial building off the ground for that reason. But also what it allows us to do is it allows us to put more urgency on the potential tenant to make a decision, because there are others in the market who have the certainty and are being motivated to also make decisions, because the opportunity won't be there forever. There's not another 627 Chapel Street in the market.
And how has it been received? It raises a good
Very
point.
strong, So from the day we launched the leasing campaign up to COVID, it was very strong. Extremely strong. Number of heads of agreements have gone out into the marketplace. I'd be lying if I said to you that COVID didn't put a pause on those heads going to AFLs, but that's happening. So we're starting to see now the dialogue come back, and in the coming 2-3 months, we should start to see some of those heads convert to AFLs, and that's for a substantial portion of the building.
And do you think that's part of a broader trend, particularly given COVID, whereby offices will start to decentralise away from the CBD into precincts like South Yarra?
Without it sounding like a self-fulfilling prophecy, I actually think that COVID's done us a favour. Decentralisation is obviously a positive for us. The requirement for smaller plates. So if the flexible workforce is really going to become a thing and companies need less space, the smaller plates we've got will be more suitable to that. I think post-COVID, there are other advantages that we never envisaged when we launched the property that are actually going to work in our favour.
And what are some of the things that tenants want to see in a building like 627 Chapel Street? I mean, is it, you mentioned there smaller floor plates, but what else? I mean, end-of-trip facilities.
So end-of-trip. So our brief or target was to deliver the best end-of-trip facilities of any building anywhere in Australia. I believe we've met that brief. Cox, who designed the building, have done a tremendous job in delivering hotel quality or style end-of-trip facilities. Being near transport is imperative. We've got South Yarra Station and we've got 2 tram lines, so that creates a lot of opportunity for employers to attract talent. And the technology. So we engage a group called Meld, who I believe are the leaders in building tech, and they put a brief together to ensure the building was not only going to be at the forefront in terms of technology the day it opens, but also for the next decade to come. So there's a lot of technology being put into the building. For instance, it's a Lanyon-free environment, so everyone will have an app on their phone to access the smart lifts to get into the building, etc. Things like that.
And moving back to the company as a whole, Goldfields Group, I mean, you guys obviously, with 627 Chapel Street, you're not just doing residential projects, you're doing office projects, you're doing land subdivision projects, doing other commercial projects. How important do you think it is to have a diversified project pipeline as opposed to just focusing on the one sector?
Diversity has always been a good hedge against risk. Different sectors will always perform at different speeds. So just from that viewpoint, if one sector's soft, hopefully other sectors are performing, and that's allowed us to turn the taps on more in relation to those sectors. So at the moment, I'd say that the office sector, especially post-COVID, non-CBD inner, will continue to perform very strongly. Land, in my view, will continue to perform very strongly, not only off the back of the grant, but I think the grant will set us up for the next phase of growth in land, but also I think there's more stimulus coming around land as well. So apart from creating broader opportunities, it creates a hedging position for us as a company.
And what are some of the fundamentals you look for, whether you're assessing an office development or a residential land subdivision? What are some of those site fundamentals you look for? Whenever
we look at a property, return on capital is foremost. As much as we're passionate about what we do and we love the idea of evolving the business to look at different sectors, it's all about how much we can make at the end of the day for the capital investment, because if we're not making money, we're not in business. So that's the primary goal. So it's about balancing that objective with delivering a product we're proud of and being very good in the sectors that we're participating.
Now, Marco, you were in the press last week in regards to the tie-up between IDA Property Group and Goldfields Group. Tell us about that.
Adam Kay, who's the principal at IDA, and I have known each other for almost 20 years. They've been involved in various deals with us. And I think, as I mentioned earlier, out of the GFC, he had positioned his business to take advantage of the opportunities for the non-bank sector. So Adam and I have had a very good relationship. We've had enough arguments and fights, to know that we can trust each other and get on and transact. But I'll make it clear, we're not setting up an arrangement that limits either company's ability to still continue to transact and do what they've always done. But there's a very specific mandate around this capital raise, which is to go after, in terms of the built form space, residential property that is well located but provides value. So what we're seeing is strong demand or interest from the channel and aggregation groups for product that values well and is well located in terms of amenity. So this fund in particular will go after those types of assets that have those attributes. We'll also take advantage of some land opportunities. So within our stable, we have access to good deal flow, plus there's an existing WIP, which the fund will be involved in. So for us going forward as a company, the ethos is build the capital base, which will then aid and support the growth. So this relationship with IDA is one plank, or key plank in that growth strategy as we continue to build our capital base.
And the focus will be residential projects along the east coast?
Yes, yeah, eastern seaboard, that's right, land and built form.
And do you see any particular opportunity in, any regions, whether it's in a Melbourne, in a Sydney,
Yeah, so Goldfields is heavily invested in Ballarat, and we've seen tremendous demand and growth happening up there, and at the moment, keeping it simple, that market's on fire. And we think that trend up there will continue for some time. Built form's always a challenge in the regions, just because of the cost of the building. Land is cheap, but unfortunately most of the cost sits within construction, and therefore it's very hard to make apartments within regions work. There's greater opportunities in New South Wales for that to happen, and parts of Queensland, but Vic is very difficult outside of Melbourne and Geelong. But certainly as the company evolves, we're not averse to any new growth opportunities. It's what we've done as a business since 2010.
And just on, say, for example, Ballarat, where do you find the buyer demand comes from? Is it local? Is it people moving out of Melbourne?
It's a combination of both. So you've got local demand, just as that market grows organically. You've got the state government decentralising certain departments, creating jobs up there, private sector creating jobs there, which brings more demand. So that's localised demand. But we've seen people almost have a sea change. So they're seeing the value proposition and lifestyle opportunities by going from a Melbourne suburban housing estate to a Ballarat housing estate where the land's cheaper but the blocks are bigger with the same level of amenity. So if you don't have an affinity or desire to need to be in the city regularly, there's a greater lifestyle and more cost-effective lifestyle opportunity in Ballarat.
And how important, I was looking on your website earlier, you've got swimming pools and tennis courts in these communities. How much of a drawing point for buyers is that?
Yeah, so we're selective where we will do a residence club, but it is a differentiator. There are certain buyers who will gravitate to the estate purely because of that amenity, and they see the opportunity that affords them and their children as they grow up within the housing estate. So the economics of it need to stack up, but at the same time, if we assess the market as being one that will actually value that amenity and it works within the economic calculation, then we're likely to go forward with a residence club.
And just again, in a Sydney context, where do you find the opportunities there, or what challenges are there? You mentioned obviously competing on some of these projects, but where's the opportunity that you guys see?
Unlike every other developer, most good deals come through your networks and they're off market. So we've got a network through Melbourne, Sydney, Brisbane, Adelaide that we're regularly in dialogue with and contact with. Sydney, to a lesser extent Melbourne, but Sydney certainly experienced a huge level of demand from offshore investors through probably 2010 through the 2018, late 17, 18, which made it very hard for local developers who were not well capitalised to compete. Certainly that pressure's come out, but we're seeing an emergence of local, well-capitalised developers now coming to the fore. It was never easy, Sydney, and it still isn't easy, but there are opportunities out there if you know how to find them.
And where do you think construction costs are going? Some people are saying they're going to be reduced. Some people say they're going to be increased due to less tenders and less competition in the building space. What are your thoughts?
I think we're at a unique juncture in terms of construction. So we've got a situation where I genuinely think that builders will be pricing to win jobs because just their future pipeline is not what it was. So they've got their own pressures to win work. So I actually think if you take out the cost of materials, the cost of delivering the building will be cheaper. But the conflict that we've got is there is a huge pipeline of infrastructure projects And I believe as part of the future stimulus plans, the government will announce more infrastructure projects, which will put pressure on materials. So it's going to be about balancing the cost of labour, the cost of delivering the building with the cost of materials and seeing where that ends up. We are seeing today very sharply priced jobs. So as we go into the market to price jobs, we're seeing very sharp pricing come back. But I feel there'll be real pressure on materials.
I noticed last week in one of those articles you were mentioning, you were pretty bullish on housing and the undersupply of housing in 2022. Why do you take that point of view?
You only have to look at the stats in terms of starts, unit starts. So that comment was made in the context of apartments. 2016, I think, was the peak in terms of unit starts ever. It was circa 114,000 starts. 2019 it dropped to, I think, 68,000 starts, and there's no doubt 2020 is going to be significantly less than that. So whilst we're going to have a migration drop off, it's not going to correlate to a position where we're achieving, say, a third of where we were in 2016. So there's going to be pent-up demand. If you look at the 10-year average, which is sitting somewhere between 70 to 80,000, and I think we're going to drop to 40, 50,000 this year, that pent-up demand is sitting there waiting. So to me, there's going to be a rebound. That rebound will start towards late 2021, 2022. By that stage, population movements are happening. If there's a vaccine delivered late this year or early next year, it will happen quicker. And also, I think stimulus will well and truly have found its way through the economy and doing what it needs to do. And in addition, and I made this comment to the AFR, if you want to deliver a building in 2022, even late 2022, the first steps are taken now to do that. So just follow the data, and the pent-up demand is building. So it's a matter of, does it happen mid next year or late next year? But that demand's going to rebound back.
And with your residential projects, do you try and target owner-occupiers or investors, or do you cater to both? What are the advantages?
Land is mainly owner-occupier. Yep. Resi is a combination of both. So Sydney is a real mix. So Sydney is a market where you will find a lot more owner-occupiers living with investors, and I think that's a price point issue. Whereas in Melbourne, we tend to see separation between an investor-grade tower and an owner-occupier tower. So for us, Melbourne is more of an investor-grade strategy, whereas Sydney's a mix of both, and Brisbane is an investor-grade strategy.
And just looking back, say, over the past 6 months, presumably buyer demand dropped off in sort of late March, April. Has it rebounded quite strongly since then?
Very strongly in land. We'd actually started to see momentum building up in land before the grant, and the grant just literally turbocharged it nationally. In residential apartments, we've seen a steady level of inquiry and demand across the projects.
How has marketing projects changed, do you think, over the past 5, 10, 15 years?
Social media. Yeah, everything. Social media is everything. Yeah. I mean, REA certainly, fair to say they had the market to themselves for a long time and still do a great job. But social plays such an important part. You only need to look at the stats now across all of our sales offices as the amount of lead generation coming through social and online.
And I know you do a lot in the way of, project short films and that sort of thing. Is that the sort of content that you put out on social media to try and draw the buyers in?
Whether it's a buyer or someone who's looking to buy, they love seeing the product. And there's nothing that speaks in greater volume than a drone, flying over the estate and seeing newly built roads and lots being delivered.
Any challenges that you foresee in the market generally in terms of either getting projects through planning, that sort of thing? I mean, is planning still difficult, or are you find?
Yeah, so different jurisdictions obviously, operate within different parameters. Sydney's as hard as ever, but Sydney's always been hard. Melbourne, fair to say that VCAT used to provide, I think, a greater degree of certainty, and most inner city projects are going to VCAT these days. I think we're at a point in time where there is less certainty about which way VCAT will go on a decision. So you're taking on the risk to try and achieve a permit, but we've probably never felt this unsure about, VCAT outcomes compared to sort of maybe up to 2016, 2017. Planning has always been a challenge and continues to be a challenge. I'd say a greater challenge than what it's been in the past.
Where do you look for inspiration for your projects? Do you look overseas? Do you look at what other developers are doing? Where does that sort of
It's a good point. Look at those who are doing it best in the marketplace. It doesn't mean you have to copy them, but you can be inspired by what they're doing, the innovators, and align yourself with very good consultants. Take for instance a very good frontline architect. They are tuned in with trends and movements that are happening globally, and by virtue of using them, you're getting access to that IP. They will charge you for it, but you get access to the IP. So it's a combination of your own sort of observations, and you align that with good consultants, and you should end up with a very good, innovative sort of solution.
One final one. How long do you think it's going to take for this economic recovery to occur on a macro level in Australia?
People a lot smarter than me probably can't answer that question. If I were to guess, a vaccine will have a lot to do with it, but let's assume we're in a world where there's no vaccine. I think the Morrison government's done a fantastic job of stabilising our economy. JobKeeper to me was genius. Whilst it's only sustainable to a point, I'm certain the government's got other levers up its sleeve that it will pull as it needs to as we go beyond September. You only have to think about the stimulus in the land market. The fact it does very little, if anything, for the residential apartment market. There must be some state or federal government initiative coming to support that sector. And I think there'll be other initiatives that will support the economy and property sectors. So I think in terms of job creation, I think there's going to be a continued push to ensure there is a recovery through to the end of this year. In terms of 2021, we need population to start coming back to the levels that it was at in 2018, 2019. Global factors are going to play a big role in that in terms of how other countries deal with the pandemic. At the moment, that's not looking great. It looks as though that's got quite a tail to run. I think if we just look at it organically, I think within 12 months, population movements are happening again internationally and locally. I think we'll see the benefit of stimulus. The economy will be awash with cash. But the big thing for me is the ability for government to work with banks to create greater liquidity within the marketplace, especially for the retail buyer. If they can solve that, then I think that's going to create a very strong platform to support the growth and support the initiatives that will be in place for property going forward, because it all works together. There's no point encouraging developers to bring on supply if the liquidity is not there for the buyer to actually be able to complete their acquisitions or their sales. So to me, that's the key equation that needs to be solved. If we can solve that, property makes up, I think, 24% of GDP. When you look at property as a whole in terms of all the sectors and industries that are part of the property industry, it's a quarter of our economy hangs off property, meaning that you can stimulate and trigger growth very quickly within the sectors, but you need the banks on board as well. So the government's got a continued role to play with the banks and also with stimulus.
Marco Gattino, pleasure to have you on the program. Thanks so much for your time.
Thanks for having me. It's been enjoyable. Thank you.